Hello, welcome to It's Your Smarter Money with Dr. Laura and Professor Steve. And today we want to talk to you about riding out market ups and downs and the fact that the markets can be actually very scary sometimes. One thing is for certain is that when you're investing in the markets, you're always going to deal with uncertainty. Volatility is just fundamental to investing, and we have to expect it. Further, volatility often triggers emotional responses, and those responses, whether they are herd-like responses or whether they're individual responses, they can result in irrational decisions and missed opportunities. So, recently, Steve, I've heard some people actually say, which was to me very surprising, I want growth. I don't want to lose any money. I don't want my portfolio to go down ever. And I thought that was quite interesting because the fact is that you can never expect that. If you are looking for growth, you're going to ride a bit of the roller coaster. Now, we work very hard on making that roller coaster a baby roller coaster that's not going as high and low, but it still is a little bit of a roller coaster. And what do you do when you're on a roller coaster? You certainly don't get up out of your seat in the middle of the ride. You stay in your seat.
Yeah, and I want to make 2 points here is that, look, we're subject to the same emotions. It's just that because of our training and our experience, we're better able to ignore those emotions and think somewhat more logically about this. But sure, we're subject to these emotions. It's part of being human. And the second point is that even though the market declined, it doesn't mean you officially lost money if you don't sell. And that's part of the key. You haven't lost money if you haven't sold. Basically you have an asset that's declined in value, probably temporarily, if you don't sell.
Well, it's not a straight line. It never is.
That's right.
So it's really important to recognize that.
That's correct.
And this chart actually does a great job at explaining it. Actually, what we've seen over the course of quite a long time, this is showing from the 1980s to very recently, to the 2020s, that the average drawdown is 14%. And the truth is that last year the market was only experienced a drawdown the most of 5, which is phenomenal. And people, I think that this year is an anomaly. I would say last year was the anomaly. So we have to recognize.
Last year spoiled us all. It spoiled us all. But it's important to realize that even in years when the market was up significantly, there was no protection from a significant drawdown in many of these years, even when it ended up higher.
Yes. And so we want to make sure that we recognize that the markets are going to go up and down, and we need to just stay disciplined and stay focused on our plans so we don't get thrown out of having a problem. Do you want to go to the next slide? But before we even invest, it's really important also to understand there's a big difference between saving and investing. There are some common attributes, of course, but really when we talk about saving, we're talking about money that you need in the next year, 2 years, the next couple of years that you need for either explicit things like weddings or tuition or a home purchase or a car purchase or just your living expenses, maybe even to those emergency types of funds that you're going to need because your roof is at the end of its life, or your water heater or your car or something else. And even it's important, and oftentimes this is what we help our clients with, is even understand, well, what are your deductibles on your insurance policies and so forth, and how much risk do you have out there that might require you to have money in savings equaling cash.
And you know, that cash deficit for emergencies, perhaps something comes up in the middle of a market downturn and you didn't have a reserve, that's also what causes people to panic and make poor decisions in the middle of a drawdown in the market.
Right. But for people that have communicated with us, Steve, there are a lot of clients that we've really worked very hard at making sure that we know where their cash is coming from, whether it's coming from the actual cash bucket or even from their fixed income. There's coupons maturing and even bonds maturing. And even if they're not maturing, those are the safer, we call them stability assets,
Right.
that if we had to have access to cash in a down market, that's where we go. So it's important to know, what are your plan B types of actions?
And that's why it's such an important part of the process that we help identify what your near-term needs are for cash. And we always want to do that before you invest a dime of your money. So we make sure we're investing an appropriate amount, an amount that you can actually keep invested for a significant amount of time, so you can ride out these ups and downs.
That's right. And this chart just kind of shows a little bit more for those folks that say, oh, but I can't stomach putting my money in a bank account where I'm not making any money. Just want to bring a little bit of light to that. Investing is all about the concept of risk and reward. And so we really need to think about, if in fact you put your investments and you're only planning on holding them for a year in an investment, and I don't care if you're getting 5% return or 10% return, how much really are you going to make? I mean, 10,000 invested. Okay, so you might make $500 or even $100. I'm sorry, $1,000 off of that if you're getting a higher return. But now you're exposing yourself in that 10% to a real lot of risk. It really is only over the course of time, and really 5 years seems to be that sweet spot. That's where the exponential compounding effect starts really making a difference. If you're going to be holding investments over a 5-year period, that's when compounding starts kicking in. And you can see that $10,000 turns into 13,000, even 13,300, even at only a 6% rate. And over a 20-year period, the compounding really works. So that's what investing is all about, is taking advantage of the higher returns in a compounding effect. If you're just holding your money for a year or two, you're not going to get the benefits. So why expose yourself to that risk?
Yeah, and the other issue here too is, over a 1-year time period, the S&P's return is average about 11% a year, plus or minus almost 20% in any given year. With I'm not going to get into the probabilities, but with a high probability. But over 10 years, the S&P's return is still averages about 11%, but with a variance of only plus or minus 4.5% to 5% a year. So the longer you can stay invested in the stock market, or any growth asset class, the closer you're going to become to earning its long-term rate of return.
So when we're helping you with your portfolios, investing your portfolios, we're of course very cognizant of the environment around us. Steve and I are both students. We're economic and investment practitioners, scientists, and also even teachers, and we're very aware of these different parameters. One of the key things that we really like to look at, first of all, is what's going on with GDP, which is the growth of investments. And so as long as we're growing, there is opportunity for your investments to grow as well. And the biggest component of growth of GDP is that consumer function. It's about you and I and Steve, all of us just going out and buying ourselves new cars or new refrigerators, or even the food on our table. That is, we drive the biggest number there. There's also investment spending, there's government spending, and also international, but it's really the consumer that drives all of that. And Steve and I were talking about earlier today how the consumer is pretty strong these days.
It is
not as much debt as there used to be.
no.
So it appears that GDP is going well. And I think the next slide actually shows that.
Yeah, and I want to mention that because of COVID, in part, people stayed in their homes for almost at least a year, and they didn't go out to restaurants. They didn't spend money on things like travel. And so the consumer's balance sheets actually improved over the last 2 or 3 years for that reason. So there's probably a lot of pent up demand among consumers for future spending there, which, as Laura said, drives GDP. And by the way, that 16% you see here includes house purchases, but also reinvestment in capital. So companies that buy equipment, things of that nature, research and development. And by the way, that is really the seed corn of the economy. That's what's really going to help the economy grow in the long term, are those investments. Because consumer spending really is focused on the current. They spend currently, but it's that investment that really helps build the economy for future growth.
And so the businesses are looking out and they're seeing a positive future because they're investing.
Yes.
And so the question is always, where are we in the business cycle? Are we in an expansion or are we in a contraction? Where exactly we are. And this is always one of those kind of questionable items that usually we don't know until we look back and we say, oh, yeah, if we had known this, now we know we were in a recovery. But I don't get the feeling that we're in a contraction.
No, not when we highlight the last quarter's GDP, it doesn't show a contraction. And we'll see that. There it is. And this shows you the annualized growth in GDP by quarter, actually. And the last quarter, which came out today, was 6.9%. So that doesn't mean the economy grew 6.9% in that quarter, but it grew at that annualized rate of 6.9%. And that's really high. And a lot of it has to do with the post-COVID recovery. The long-term growth rate for the economies range between 2 to 3% a year, long-term. So
that's a positive number.
Yeah, it's a great number, 6.9%, quite honestly. And like we said, that shows the post-COVID recovery, and hopefully that will continue.
And that's what we're seeing in a lot of the other indicators as well. We monitor those indicators. We, everything from inflation to interest rates to capacity utilization and so forth. We have a couple of slides on a couple of them that we look at. One thing that Steve mentioned that we didn't include was the AAI investment sentiment on here, which is actually not positive. Although I would not say, I'd say that's a lagging indicator, not necessarily a predictive indicator, if you will, of what the economy is doing.
Yeah.
So we go to the governmental databases to pull different information. This just shows over the past year that that labor is coming back. It's not back to where it was in 2019, but it is coming back.
Yeah, and this is the labor participation rate, which means what percent of the population is actually working, has some type of job. And so it had reached, I guess, a number exceeding about 63% a couple of years ago, and it dropped a lot during the COVID panic. But now, because we saw high unemployment, we saw unemployment rise dramatically for a short period of time, but now it is gradually increasing. And I think, especially as some of the government stimulus and some of the government programs, including unemployment, has ended, more people are realizing they have to go back to work. So I think the participation rate will probably continue to rise.
Yeah, people are feeling safer as well.
Yes, good point.
Capacity utilization, meaning that businesses are actually using their equipment and their plants to produce goods for us. So this is doing a lot better than it was as well. It's starting to turn.
Yeah, and consumer spending is a huge driver of this, by the way. Yeah.
And I think we have one more chart on economic indicators, and this is just the investment in business. That again, businesses are investing. They do see positive things happening where they're spending their own capital and hoping to get a return on that. So that's very positive as well when we see that.
So I'd mentioned, Laura and I were talking about it earlier, that one positive thing despite the terrible pandemic we've experienced the last year and a half, 2 years, is that the economy probably didn't suffer as bad a hit as it would have suffered 30 years ago, because people were able to actually work from their homes in ways they couldn't work 30 years ago when there was no internet. People didn't have laptops. They didn't have the cell phones and that type of thing. And the economy has probably been experienced a better stability because of that, the ability that people work from their homes, even in the midst of a pandemic.
It's fascinating how resilient we've been as a society, as a country, all over the world. It's just fascinating.
Yep. Yep.
Yeah. So we don't want to get too into all of this, but we did, the government does play a role in trying to assist the overall markets. There's different policies. One is the fiscal policy, where the government is driving tax law and how they're spending money to try to stimulate the economy. The second way that the government operates, though, is with monetary policy. That's the Federal Reserve. A lot of you probably have heard a lot of talk. Jerome Powell was on recently on TV talking about what he and the FOMC, the Federal Open Market Committee, is planning to do to try to keep interest rates, keep inflation at bay by potentially influencing interest rates. And so we, of course, have an eye on that. We don't think they're going to do anything too silly. They have to do something. Inflation is potentially a problem. But of course, when interest rates start going up, that can create some headwinds on returns from both stocks and bonds. And so that is a concern.
Yep.
And this just gets a little bit, let's go past this, Steve. It's probably too in depth on whether we have a contrary contraction monetary policy or an expansion monetary. And so, so all of that to say that really, when we're looking at the overall environment, the economic environment, we don't necessarily see alarm bells going off in terms of there being a major problem in the market. And so we believe that businesses will continue to help grow the market. But because we hear things on TV and there's a lot of volatility in the market, and there's a lot going on, there's no question about that, right, Steve? I mean, Ukraine, Russia, and all these things that certainly give all of us pause. We want to make sure that we don't allow all of these different things to throw us too far off our game and to react emotionally. Reacting emotionally will never help with your investments. We've seen over and over again the documentation how that's a problem. And even trying to market time creates a lot of problem. And so that's why we went to such an extent of creating a strategy, a documented strategy for all of us, for you and for us, to use as our guiding book, that we were not going to vacillate from, that we try to stick to the strategy. This creates discipline on all of our parts so that we're not second guessing the market. Because even though I
mentioned about the market timing thing, that look, a year and a half ago, we would not have predicted that natural resources would be our best performing asset class. And it was for 2021. That asset class is up 50%. And the year before, we could not have predicted that convertible bonds were going to be the best asset class. They were up about 50% in 2020. And that just shows the folly of trying to decide what the next winning asset class is going to be. And that leads right into this market timing thing. We can't predict these things. No one really can.
I want to mention too that natural resources is driving, it's the top performing asset class this year as well.
It's up about almost 6% right now.
And we're in January. We're still in January. So
that's right.
That's quite, it could potentially be the top performing asset class again.
And it's doing its job. We expect it to perform better in times of higher inflation. And we also like the fact that it's not exhibiting correlation with the rest of our assets. It's actually improving diversification.
So we're students of this behavioral finance body of literature that's out there. There's quite a lot out there. We know a lot of the mistakes that can be made. We try to learn it also so that we can help each other not make these mistakes and help our clients not make these mistakes.
Yes.
And so, Steve, if you can go to the next slide. This is
a great slide, Laura, by the way. This really is.
Explain that.
Yeah, you can explain it. The average mutual fund investor, because they try to make timing decisions, or they perhaps panic when the market declines by 30%, and it will decline by 30% again at some point. They sell, but they don't get back in when the market begins its recovery, or they miss part of the recovery. So this comes out of some studies. I guess I'm not sure out of Dalbar. You can Google Dalbar. They're on the internet. The average mutual fund investor average about 0.2% return, right, over the average of 20 years, whereas the S&P averaged 8% return a year. I mean, that's crazy.
Dalbar is a highly respected research think tank firm up in Massachusetts, and they put out a lot of great information. And they've put out, I mean, this is the case over and over again. They redo the study and they find the same dynamics happening over and over again.
Yep.
I particularly like this slide, even though it's a little dated. It kind of shows what happened the last time we had a really major market correction. This is the S&P 500 over that period of time from 2000 to 2010 that we are all trying to forget. And it shows the line is the S&P 500, the valuation, and the circle on the the second x-axis is the valuation. And you can see that if you just stayed in the S&P 500 and did not move, did not do a thing, you might have just kept your money whole. Unfortunately, that's not what people did. And so on the first y-axis, it shows all the cash flows into the market in millions of dollars and all the cash flows out of the market in millions of dollars. And take a look at where the major cash flows were coming out of the market. This actually occurred in April of 2009, the very, very bottom of the market. And so this is what we see, is we see people throw money in as the market's going up. They're all interested in risk and growth, and I can handle it. And then they go to the opposite side when the market's not doing well and they want to take money out. That is not the buy low, sell high philosophy.
And I remember 2002 vividly, by the way. We had experienced the end of the internet, a growth period from which ended around 1999 to 2000. And the market really didn't start to recover until 2002. And when does all the money flow out? In 2002. So a lot of that was they used to call that a capitulation, and it was a sign that the market was actually going to start turning around when the people that shouldn't have been in the market finally get out.
Right. Well, with
their losses.
Steve, this chart, if you look at the first green bar that actually has a 2 by it, that shows what happened in 2002. What's not highlighted as strongly is all the way at the end of the chart where you see the money coming out as well, and that's in 2008. And so imagine this, and this is what we saw. People put money in the market in the beginning of 2000. Okay, you put $1,000 in, you take it out at the end of 2002. So now you have $500. You then go and you start putting the money in as the market's rising again. You put the $500 in, you take it out in 2008. You now have $250. I mean, we saw that. It's crazy. And those same people, they took it out in 2009, and they were still sitting there in 2015 saying,
that's right.
When do I get back in?
Yeah, I was going to mention that. And we actually had a couple people came to us with their 401ks, and they had cashed them out, whatever the money market option was within it, in sometime in 08. And 6-7 years later, they were still in cash. They had missed 80% run up of the market, 70% run up. which is sad. You'll never recover that run up ever. It's gone forever if you miss it.
So there's a whole bunch of different things pulling at us. If you turn on the TV, if you listen to your friends, a lot of people are getting very nervous, and you're going to start seeing people talking about the market. Maybe this time is different. That's the thing we always hear. Maybe this time is different. And we just wanted to remind ourselves and you that this time is probably not so different. We've heard this over and over and over again.
Well, we don't have the slide here. We can show it in, I think it was 1981 Time Magazine. I don't know what it is about Time Magazine, but they had a front page article that said, asked, are equities dead? Right before one of the greatest run-ups from 81 to 87 in the market.
But then in 87, you got this cover that said, everything's falling apart. And then there was another article that came out at a time again in 1990. I like this one. It's basically that I want to say we're in a recession, but that's not strong enough. We're in, it's a depression. And, that was the beginning of the 90s, which if you had just stayed still and stayed in the market, you would have.
The only good part about this is I like that picture of the guy hanging from the clock.
Quite impactful, right?
Yeah. And look, Time is selling is never rely on these magazines for investment advice. They're selling a product, they're selling themselves. And they want you to jump up and say, oh, gee, I want to buy that when you're standing at the supermarket line, seeing it there.
It's entertainment.
Yes.
Again, Time. I was looking for some other magazines. I'm picking on Time. Time isn't the only one.
No.
But it is another one. This was actually the recession. There was a slight little recession in the early 1990s.
Very minor.
It was over.
Yeah.
By this time, it was over, and they had published this article.
In fact, poor President Bush, he in part lost the election.
Oh yeah.
The media was still saying we were in recession when we were already coming out of it.
Yeah, Clint was saying it's the economy, stupid, right? he used it. He played it. Good for him.
Yeah, exactly.
So, and then we have, of course, Y2K, and everything was going to fall apart then, and things did happen.
Business Week should know better. I mean, I can see Time Magazine, but Business Week should know better.
Yeah, and then in 2003 there was the SARS epidemic, and that of course was a lot less than what we're experiencing right now, and it went through right now. But there was a lot of fear, and people were reacting to that fear, and that's what we want to make sure that we don't react to headlines. We're looking at fundamentals, and we're saying there's nothing in the fundamentals that we see that's really broken. We know that investing over the long run is going to pay back. The markets reward people that stay disciplined.
That's right.
This chart actually was the last chart we were going to show you, really, which was just performance of some of the top asset classes that we use in your portfolio and how they did in from 2000 to 2020.
But these are indices, not actual holdings, but we use a lot of index funds which track these.
Right. But you can see the S&P 500 kind of not really going too far in the first 10 years, especially. And some of the other asset classes doing a lot better. What I find really interesting, though, and very important to remind everybody, is that there are times where all the asset classes do correlate. They all start performing exactly the same. And so you might have said back in 2008, oh, why are they all performing the same? They're all going down. That's a problem. Although not all of them. Bonds did not go down, but a lot of them did go all down at the same time. The thing is that they don't just stay down together, that a lot of them popped back up again. So if you look at, for example, the purple line there is international small cap stock that popped up right away, as well as real estate investment trusts that popped up right away. So there were investments that pulled the portfolios back up again. And a lot of our portfolios in that period, yes, they went down, I'm not going to tell you your portfolio is not going to go down. And
No.
anybody that thinks they're never going to see a negative number on their portfolio quarterly statements, we need to talk, because you are going to see down times. The question is, over the long run, are you going to be better off? Are you going to be ahead of the game? And we believe you are, based upon all the science and all the work that we've done.
That's right.
Our portfolio has popped up out of this 2008-9 recessionary period pretty quickly. I want to say, Steve,
18 months or so, I would say
Yeah.
they recovered completely, 18 to 20 months.
whereas the
Yeah,
S&P didn't really, there are a lot of people that didn't recover till like 2015 or so.
That's right. That's right. Yeah. Yep.
So we want to make sure that everybody has their they're buckling up and okay to take a ride if the markets decide to take us for a ride. We don't know what's going to happen. For all we know, we published this video and we have another smooth year. That would be wonderful.
Yeah.
We would love that. We do think that there's a lot of tension in the air. There are a lot of things going on that will probably drive volatility. And so how much of that volatility is driven by just people's emotions versus a real reason to be volatile? We think it's a lot of the emotions that's driving that. And so we're not going to play that game. We're not going to allow ourselves to get involved in that.
No, nope. That's correct.
So it's important to know, again, when you decide to flee the market based upon these things, you are making a prediction of what the outcome is going to be. And again, it's very, very hard to understand all the factors. There's many factors that go into how the market behaves. A lot of times people think they know how the market's going to behave based upon something that happens. And oftentimes the exact opposite happens. So it's important to know that. And we're big believers that the markets are generally fairly efficient. And so that means that all the information is out there. So it's not like you're second guessing or you have some superior knowledge to know what exactly is happening. And so
that's right. Yep.
We think that some of you will have questions and some of you may need some support when things do get volatile. We want you to know that we are here. We want to help educate you, help keep you strong, keep you disciplined and staying on your path so that you can be successful. So please contact us if you have any questions or want to talk. Thank you.